Okay, so we're on part C where it says explain the purpose of money markets, identify the major money market segments in Zambia, and describe the key money market instruments commonly traded. All right, colleagues. So the money market, this is where short-term securities are sold. Okay, short-term securities are sold. These short-term securities mature. The maximum is a year and below. The maturity dates are either a year or below a year. Okay, the timeline is a year for these securities in the money markets. Okay, yes. So as you can see here, the definition: money markets are part of the financial system where short-term funds are borrowed and lent, usually for less than 1 year. Okay. So now we're going to look at what is the purpose of the money markets. Mm-hmm. I'm recording. Recording. Yes. So yes, we're back on the purpose of money markets. So overall, in simple words, it helps businesses and government get short-term finance. That's the key purpose of these money markets. Short-term financing. Okay. As a business or as a government, you have expenses that you need to pay. Okay. You need also money for operations, basic to carry out your activities and your operations. All right. So this money market gives you an avenue to source short-term financing. All right. So here's we can go through. Okay. Number one, to manage short-term liquidity. Okay. Banks and companies often experience short-term cash shortages, even when they are financially stable. Money markets allow them to borrow funds quickly, usually overnight or for a few days. Okay. So here's an example. A bank in Osaka faces high customer withdrawals in the morning and borrows overnight from another bank to meet the payments. So customers are withdrawing, money is finishing within the bank. The bank needs fast money, it needs quick money. All right. So it's going to borrow from another bank. Mhm. Yes. To help government raise short-term funds. Remember treasury bills. These are the one of the instruments traded in the money markets as we're going to say as we go along the question. All right. Yes. So if government needs short-term financing, it issues out treasury bills. Okay. Yes. For example, so government spending is continuous, while revenue from taxes comes at specific times, creating funding gaps. Okay, so as you're waiting on the money from taxes, you still need money. So that money is not going to come now. So you need money immediately. Okay, so that's where treasury bills come in, right? Yes. So if government needs short-term financing, the money markets help government get short-term financing. Okay. So number one, they help um, manage short-term liquidity. Remember, when we talk about liquidity, it's having money on hand so that you can take care of bills, all right, expenses and obligations. Okay, that's number one. It helps business obtain short-term liquidity. It enables businesses to gather funds that they can use in the short run, right? Then number two, it helps government raise short-term funds, right? Number three, all right, and the third role of the money market to provide safe short-term investment opportunities. Okay. Institutions with excess cash need secure places to invest without risk or loss. Money markets instruments offer safety and short maturity periods. Okay. So, like the insurance companies, okay, and NAPSA, the pension funds, yes, they've collected your money, but they would also want to invest that money, make extra money, and also for themselves and for you. Okay. So the money market provides a platform where there are what's this investments, short-term investments, where they can invest, and these short-term investments can be of low risk. And this short-term investment we're talking about is treasury bills. Okay. So if NAPSA or your insurance company has collected your money and they want to invest that money in the short term so that they can earn some returns, they'll buy treasury bills through the money market. Okay, number four, to support monetary policy implementation. Colleagues, remember what monetary policy is, how the central bank attempts to influence the economy through interest rates and money supply. All right. Yes. So the Bank of Zambia uses money markets to control the amount of money in circulation and influence inflation and interest rates. All right. Yes. Remember, the central bank pumps in money into the economy, and they can also withdraw, they can also take out money out of the economy. All right. They do this by trading treasury bills with commercial banks. So if there's a lot of money in circulation and there is inflation, what the central bank is going to do is it's going to sell treasury bills to the commercial banks. It sells these treasury bills to the commercial banks purchase these treasury bills. When the commercial banks purchase the treasury bills, it means the central bank is now removing money out of circulation. Okay? It's removing money out of circulation. And the other effect is going to be this. Since the central bank is removing money out of circulation from the commercial banks will have less money with themselves. And when the commercial bank has less money, it means interest rates are going to rise. Okay. So the reason why those interest rates are going to rise so that people stop excessive borrowing because there's high inflation. Okay. Too much money in circulation and excessive borrowing. So what the central bank can do to fight inflation is through open market operations. This is where the central bank, remember, open market operations where the central bank is trading treasury bills with commercial banks. Okay. So when it sells those treasury bills to the commercial banks, it pulls money out of circulation. The central banks have less money in their reserve. The commercial banks have less money in their reserves. Interest rates go up. Okay, that way there'll be less money in circulation and less excessive borrowing. So inflation is going to cool down. Okay, we're talking about demand pull inflation. Okay, I hope we remember demand pull inflation. And then also, if the economy is undergoing a recession, right, high unemployment, low GDP, right, the central bank can pump in money into circulation, okay, so that to influence spending within the economy, right? So, what the central bank will do is it buys treasury bills from commercial banks. Once it gets those treasury bills from the commercial banks, it's pumping in money into the commercial banks. Commercial banks have high reserves now. They've got high abundant amount of money. They will now lower interest rates. When they lower interest rates, government and businesses can borrow now so that, like for government, government starts spending so that unemployment levels start um, drop. Okay, government can hire teachers, nurses, defense personnel, all right, so that people get employed and have got money. Government is also going to be buying goods and services from other companies, all right. Those company and also the companies which also borrow from with these low interest rates, they can now get back to operations, all right. They can now, since there was no money during the recession, these companies had less money to operate, and uh, the workforce has been laid off. Once these companies can borrow back the money, they can get back to their normal operations. Okay, so yes, that's how the money markets help monetary policy implementation. Okay, through, because when the central bank is buying treasury bills or selling treasury bills with commercial banks, that's the money market there, because they're trading in treasury bills, a short-term security. Yes. Okay, the major segments in the money market: the intermarket bank. Okay, commercial banks lend and borrow money from each other to balance daily liquidity positions. All right, yes, so banks can borrow from each other. Okay, the treasury bill market. All right, where treasury bills are sold. Right, open market operations. All right, this is where we said central bank and commercial banks are trading in treasury bills, right? This is just for Zambia. Okay, those are the major money market segments. Then the key money market instruments: treasury bills, as we talked about. Okay, they mature within 91, 182, or 364 days. All right, so as you can see, their maturity never exceeds a year. Okay, inter interbank loans. Okay, short-term lending between commercial banks, usually overnight. Okay, so these interbank loans, it's these are short-term loans. Okay, the one who's borrowing doesn't have to pay after 2 years or 5 years. No, it's a short term. They have to pay within a year or less. Right? Yeah. So maybe let's say Stanbic borrows 3 million overnight from Zanaco to meet customer withdrawals. Okay. Then you've got repurchase agreements. Repurchase agreements work like this. For example, I need money from you. So I tell you, let's say I need a 10,000 from Mr. X. Okay. So I tell Mr. X, okay, I need a 10,000 from you so you can hold my car. All right. Then when I'm coming to pay you back, I'll give you a 13,000. So basically what's happening in that transaction is it's like I've sold Mr. X my car. And then when I get the money back, I'm going to buy back my car at a higher price. All right. Yes. So you're telling someone to hold, it's like you tell someone, hold this asset of mine, and then I'll come and buy it back from you. Yeah. So initially you're saying, okay, I'm selling you this asset, but I'm coming back to buy it from you. Okay. So now here in the money markets, it's treasury bills. All right. One bank will say, hold these treasury bills. All right. Then when once you have the money, we'll buy back these treasury bills at a higher price. Okay, those are what's repurchase agreements. Short-term borrowing where securities are sold and later repurchased at a higher price. Okay, and then commercial papers, short-term unsecured borrowing by large companies to finance working capital needs. Okay. Yes. Also, certificates of deposit. Forgot to put here. Certificates of deposit, where you deposit money, let's say for a year, a huge amount. Okay, not just small amounts like a 1,000. No, no, no. A big amounts like a 500,000, a 1 million, big amounts. All right. Uh, you put that money in the bank, and the bank says, don't touch this money, let's say for a year. Then after a year passes, we're going to give you back your money and offer you a high interest. All right, that's what a certificate of deposit is. It's almost like you're depositing in a savings account, but this time it's for a short while. Okay, it's for a short while. You give the bank a big amount of money for a short while, within, and you'll be paid, and you'll be given back that money with interest, a high interest, either within a year or less. Okay, those are certificates of deposit. So yes, those are some of the instruments in the money market. Treasury bills for government short-term financing, interbank loans for short-term financing for banks, repurchase agreements, also short-term financing for banks, even businesses. Okay, and then repurchase agreements, then commercial papers for businesses that need short-term financing, then certificates of deposits. Also, again, it's for banks. Okay. Yes. So remember this: for government, treasury bills; for businesses, commercial papers; for banks, certificate of deposit, interbank loans, and repurchase agreements. Okay. Yes. So that's finalizes questions. The question.